So far, 2024 has been a roller coaster. The first quarter was filled with excitement, while the second quarter, not so much. As things have cooled down though, everyone has been wondering about the state of the market. And if there's anyone with an ear to the ground, it's crypto price tracking platforms. So, when they release a report summing everything up, it's best to pay attention. Today, we'll break down this report for you, give you an overview of what's been happening, and tell you where we could be heading next. The report we'll be summarizing today is the 2024 Q2 Crypto Industry Report published by CoinGecko. It's a good few pages long, so we'll stick to giving you the juicy bits here, but we'll leave a link to the full report in the description for you to check out. Now, the report begins by looking at the market landscape, starting with an overview of the spot market, which, to be honest, makes for pretty disappointing reading. After a bunch of sideways movement, crypto's total market cap dropped 14% in Q2, while trading volumes declined by 17%. Obviously, that's changed somewhat in recent days. Anyways, in that time, the crypto leaderboard has shuffled around a bit. Toncoin moved from 15th place to become a top 10 project by market cap. Be sure to check out our review about it. The link will be down below, by the way. Creeping into the top 30, meanwhile, were Pepe, Casper's CAS, Athena's USDE, Monero's XMR, and FET, which was originally Fetch.ai before it merged with Ocean Protocol and SingularityNet to form the Artificial Superintelligence Alliance, which sounds a bit like something the Avengers would use. Of course, as cryptos join the top 30, others have to leave, and those in question were Arbitrum's ARB, Dogwifhat's WIF, Cosmos's Atom, Stax's STX, and Filecoin's Phil. The report then moves on to what would probably be our good friend Benjamin Cowen's favourite page of all, and that's market cap dominance. Unsurprisingly, BTC maintained more than 50% dominance of crypto's total market cap. By contrast, ETH dominance was just 17%, while most other altcoins continued to decline. As the report highlights, this represents a flight to safety, and it's likely that this will continue for some time, especially now that the Bitcoin and Ethereum spot ETFs are up and running. Next, the report analyzes the price performance of the top 5 cryptos by market cap, as well as the top 5 DeFi projects, exchange tokens, and play-to-earn tokens. As you can clearly see from the chart provided, cryptos took a beating in Q2 compared with Q1, pretty much across the board. Of the top 5 cryptos, Sol took the biggest L in Q2, falling by 28%. The Graphs GRT was DeFi's biggest loser, falling by as much as 46%. Kronos' CRO token was the biggest loser of exchange tokens, and Gala was the worst performing play-to-earn token after falling 60%. Newcomer Notcoin is highlighted as being the exception to the rule here, closing Q2 with an increase of 95%, although at the time of shooting, Not is actually down 50% from its all-time high. You win some, you lose some. Meanwhile, the market cap of stablecoins grew by almost 7% despite the 14% decline in the overall market. These gains were largely driven by USDT and Athena's USDE, the latter of which saw its market cap grow by a staggering 134%. Definitely one to watch going forward. Other notable movements include PayPal's PYUSD, which grew by 124%, and FDUSD, which struggled against its counterparts, declining by 18%. And by the way, if you're enjoying the video so far, show some love by smashing that like button and subscribe to the channel if you haven't already. Don't forget to ping that notification bell too so you don't miss our next one. And if you're looking to maximize your crypto gains, then you have to check out the Coin Bureau deals page. You can get up to 70% discounts on trading fees, up to $100,000 in sign-up bonuses, and discounts on the best hardware wallets out there to stash your stacks on. The link is in the description, so take advantage of that before it's too late. Okay, moving on. Next, the report reveals the most popular crypto categories of Q2. Meme coins, real-world assets or RWAs, and AI cryptos account for over a third of CoinGecko's web traffic. Perhaps unsurprisingly, the crown goes to meme coins, accounting for 14% of all traffic. What's crazy is that cat-themed memes now have their own category, and even that's made it into the top 15, along with the entirety of the Ethereum, Solana, and Base ecosystems. Only in crypto, folks. The report then looks at a number of new projects that launched with a low float and a high fully diluted valuation, or FDV. You'll have to check out the full report to see what those projects are, but if you watched our video explaining why FDV is so important, you'll know that this can be a recipe for prices to plummet. And lo and behold, that's exactly what happened to these cryptos. The link to that video is in the description, by the way. Now, the next part of the report takes a closer look at Bitcoin's BTC. As loved as BTC is, it had a fairly weak performance in Q2, having declined by 12%. Notably, Bitcoin's halving hasn't had much of an effect on price, and attention has instead turned to Mt. Gox after it started moving over 140,000 BTC after 10 agonizing years. And it wasn't just BTC's price that saw a decline. Bitcoin's mining hash rate also decreased by almost 19%, the first quarterly decline since Q2 of 2022. BTC also underperformed against every traditional major asset class out there. We're talking the S&P, the Nasdaq, as well as oil, gold, and currencies like the euro and even the Japanese yen. It's safe to say the situation has changed a bit, though. In any case, next, the report turns to the recently launched Runes protocol. If you watched our video on Runes, you'll know that this was launched at the same time as the halving and was created by the same dev who brought us ordinals and inscriptions. Link in the description if you want to learn more. Anywho, the report highlights that Runes haven't exactly lived up to the hype. When Runes went live on the 19th of April, there was a rush of new users, and just 4 days later, it saw more than 750,000 daily transactions. However, the following week, transactions dropped to just over 130,000. At the close of Q2, there were just 28,000 transactions, an overall decline of 93%. Next, the report reviews the spot Bitcoin ETF flows. Like pretty much everything else we've gone over so far, these also saw a decline. While the ETFs experienced $2.4 billion in net inflows in Q2, the total assets under management, or AUM, actually went down by 7%. Again, this has changed quite recently. BlackRock's IBIT remains the leader with 35% of the AUM market share. Specifically, it has almost $19 billion in AUM and the lion's share of trading volume at around 50%. Now, the next part of the report looks at the second largest crypto, Ethereum. It notes that despite the surprise approval of spot Ethereum ETFs, ETH's price actually declined by over 5% in Q2, falling by around $300. Unfortunately, ETH still seems to be lagging after the ETF listings. The report explains that ETH had been on a downtrend for a while and, after a price spike generated by the sudden ETF approvals, continued its downward momentum once the excitement faded. Again, it seems this trend continues despite the listings. The report highlights that the majority of activity seems to be happening on Layer 2s and on Solana, although for the latter, it's likely this isn't accurate. That's simply because Solana is coded in such a way that failed transactions are counted towards the total transaction count, which doesn't give a very honest view of what's going on. Also recall that Solana took the biggest loss of any of the top 5 crypto projects at 28%, whereas ETH only declined by 6%. Surely, if Solana was now the go-to chain, this would have supported prices, but I digress. Moving on, the report notes one sector that has seen significant growth, and that's restaking. In Q2, the number of restaked ETH grew by 34%, with 71% being restaked with liquid staking protocols. What's crazy is that 95% of restaked ETH market share is held by EigenLayer. The report then discusses ETH's burn rate, which fell dramatically by 66% as network activity slowed down. As a result, ETH has become inflationary for the first time this year, adding 120,000 to its supply. More supply with the same or less demand means prices go lower, and well, that's basically what happened. And finally, the report looks at Ethereum Layer 2s, which had a total of more than 1.2 billion transactions in Q2. Taking the lion's share of these is OPBNB, which accounted for 34% of Layer 2 transactions in Q2. Overall, though, Layer 2 transactions are up 37% from Q1, and so far this year there's been double the amount of transactions compared to 2023, and we still have 2 quarters to go. Not bad at all, given the apparent lack of interest we're seeing. Now, the next part of the report looks at Solana. As you'll know, Solana has become a bit of a degen haven recently, and this is highlighted straight off the bat. While Sol's price tumbled 28%, meme coins and celebrity tokens continued to outperform. Incidentally, we recently did a video about celebrity tokens, and you know where to go to find it. Now, while Sol might have gained 44% since the start of the year to hit the $200 mark by April, it fell 28% and has yet to recover to those levels, although at the time of shooting, Sol has been on a bit of a tear. The report attributes Sol's relative strength to the continued activity fueled by Pump.Fun, which has made launching shitcoins easier than ever. It also mentions VanEck's application for a spot Solana ETF in late June as a reason for a spike in Sol's price, and perhaps this is partly why Sol has recently been rallying. I mean, now that Ethereum ETFs are out there, it's only logical that this speculative capital would rotate into the next big thing. But going back to Pump.Fun, the report takes a closer look at the proliferation of meme coins launched there. It's not a small number either. In fact, the report states that there have been almost 1.2 million meme coins launched on Pump.Fun since the 1st of July. That is insanity, and is probably a lot higher by the time you watch this video. Anyway, aside from discussing meme coins, the report doesn't really have much more to say on Solana. The thing is, we reckon that Solana has much more potential than just being a shitcoin casino, and could even become the highest performing L1 of this cycle. You can find out why by watching our Solana update video, linked to, of course, below. Okay. The next part of the report analyses the DeFi sector. It starts by noting that DeFi's market cap closed Q2 with a 20% decline, despite an apparent rally caused by the surprise Ethereum ETF approvals. Notably, DeFi's market cap had been consistently floating around the $90 billion range throughout May. The short-lived ETF rally put DeFi above $100 billion, but it didn't take long for it to drop back down to its previous level. Next, the report looks at which chains have dominated in DeFi, which has actually increased by 6% despite the lackluster market conditions. Ethereum remains king by quite a wide margin, retaining around 70% of the market share. Meanwhile, Solana has 5% of market activity, again thanks to the Pump.Fun meme coin craze, which is roughly the same share as Tron and the Binance Smart Chain. The report also highlights Toncoin's growth here, after the Ton blockchain attracted enough users to become the 10th largest chain by total value locked, or TVL. This growth is attributed to the success of tap-to-earn games such as Notcoin, noting that TVL on the Ton blockchain has jumped by more than 4x, from just over $200 million at the start of April to over $900 million by the end of June. We happen to think that Ton could just be getting started, and I'll remind you that you can check out our recent Toncoin video, link below. Anyhow, the report then moves on to DeFi's ecosystem, which paints a bit of a mixed picture. It starts by saying that the top 3 DeFi segments, those being liquid staking, lending protocols, and cross-chain bridges, made up 60% of DeFi's overall TVL and saw a significant decrease. Compared to Q1, these 3 segments lost around 6% in TVL, which, given the other declines we've seen so far across this report, doesn't seem all that significant, even if it did amount to $8.3 billion. Restaking, on the other hand, grew by almost 50% thanks to the ETH being staked with Eigenlayer in preparation for what was probably this year's most anticipated airdrop so far. But the biggest gains of this quarter came from Ethena, with an increase of 154% in TVL. So let's just hope the mechanics behind Ethena's native ENA token and the USDE stablecoin don't have anything resembling the Terra Luna debacle. Whew. Now, the next part of the report looks at NFTs. Starting with trading volumes across the top 10 blockchains, it's pretty clear that NFTs have had a rough ride. That's because trading volumes had fallen by almost 32% by the end of Q2. The report even states that, quote, even with the launch of runes, Bitcoin NFT volumes have plummeted significantly, while Solana is closing the gap with Ethereum NFTs. For now, though, Ethereum remains the largest NFT blockchain. Despite losing 45% of its trading activity in Q1, Ethereum still controlled 32% of trading volume in Q2. But Solana was trailing by just $17 million, according to this report, and it's entirely possible that by the time this video gets released, Solana could have become the most popular NFT chain. Meanwhile, Bitcoin NFTs saw a significant decline of 70% in trading volume following the rise and fall of runes. Next, the report looks at the difference between NFT trading platforms. At the tail end of Q1, Magic Eden overtook Blur to become the largest NFT marketplace and remains in top position. This is despite the platform's trading volume dropping by over 40% and Blur's trading volume actually going up by 25% in Q2. It closed the gap, but Blur still has a little further to go. Other platforms affected by Rune's disappointing uptake include OKX, Unisat, and Ordinal's wallet, which collectively lost over 80% of their trading activity and now have a combined market share of just 5%. And finally, the report then looks at NFT lending activity, which, in line with the rest of the NFT space, has also seen a sharp decline of over 48%. Quote, NFT lending volumes plunged by over $1 billion across Q2 as NFT winter continues. Blend continues to be the market leader for NFT lending, dominating with 93% of loan volume, but that's not to say it too hasn't taken a hit. Back in January, Blend saw $870 million in lending volume, but by the end of Q2 sat at only $287 million, about a third of what it was only a few months ago. Okay, the final section of this report takes a look at different exchanges. Starting with the top 10 centralized exchanges, it notes that these reported $3.4 trillion in trading volume in Q2, a decrease of 12% since Q1. Binance has maintained roughly 50% of the market share, keeping it comfortably in first place. Meanwhile, Bybit has emerged to become crypto's second largest centralized exchange, with a market share of 12% by the end of June. And if you want to sign up for Bybit, you'll want to watch our Bybit exchange review and be sure to use the Coin Bureau deals page to take advantage of up to $60,000 in sign-up bonuses. The links to both of those are in the description. Now, of the top 10 centralized exchanges, only 4 saw a positive growth in trading volumes in Q2. These included Gate.io, which rather impressively grew by more than 50%, BitGet, which grew by 15%, and HTX with a growth of 13%. As for decentralized exchanges, or DEXs, these have actually seen a positive growth of 15% overall in Q2. Hooray! In fact, the top 10 DEXs recorded over $370 billion in spot trading volume, and as you've probably guessed, this is once again thanks to meme coins. Uniswap is unsurprisingly the largest DEX out there, which closed out Q2 with 48% of trading volume. That's literally 4x higher than the second largest DEX, PancakeSwap. Meanwhile, Thruster was apparently Q2's biggest gainer, with trading volumes going up by over 5x since Q1, while the second largest gainer was Aerodrome, which grew by almost 4x to enter the top 10 DEX leaderboard. Next, the report looks at spot DEX trading volume by chain. Ethereum is again noted to be the most dominant chain, and despite trading volumes trending downward between April and June, Ethereum saw $162 billion of trading. Overall, trading volumes on Ethereum DEXs went up by more than 12% since the start of Q2. DEX trading activity on Solana also remains strong, comfortably taking the second place spot after overtaking Arbitrum back in March. Arbitrum now sits in fourth place after being overtaken by Base, thanks to trading volumes being boosted by, yep, you guessed it, meme coins. Meanwhile, Blast managed to break into the top 10 by the end of June with just under $4 billion in trading volume, accounting for 3% of the market share. That might not sound like much, but Blast's trading volume had grown by 474% in Q2 alone. And that pretty much brings us to the end of the report. But what does all this mean for the crypto market? Well, there's no denying that this report reveals some very bearish undertones, especially when compared to the start of the year, or the back end of 2023 for that matter. Pretty much everything has taken a hit, and most of that can be attributed to a single factor: a lack of retail investors. You'll no doubt be aware, most of crypto's activity lately has either come from large investors pumping money into the spot Bitcoin and Ethereum ETFs, or it's been veteran retail and mercenary capital gambling on meme coins. The truth is, without a major catalyst, retail investors aren't likely to return in the ways we've seen in previous cycles. On the bright side, though, This catalyst could come sooner than you think. That's because crypto is being more politicized now than ever before, as politicians begin to realize its potential. Heck, Donald Trump attended this year's Bitcoin conference. What more do I need to say? This puts the spotlight back on crypto and could help rake in millions of new users. Maybe we're seeing the beginning stages of that already. And once retail does come back, and make no mistake, they will, they'll be met with a more mature and advanced crypto industry. One with better regulatory frameworks, active Bitcoin and Ethereum spot ETFs in the United States, and crypto projects that have built some of the most innovative tech we've ever seen. They will be spoilt for choice, and they'll be even more likely to stick around. Until then, you have the upper hand, because you now have extra time to research and find those undervalued gems that could potentially make you life-changing gains. And on that note, if you're looking for altcoin gems but you don't know where to start, you should check out the Coin Bureau Club. It's got weekly reviews of promising small caps voted for by our members. You'll also get exclusive insights from members of the team, and you'll even have detailed breakdowns of our crypto portfolios and watch lists. The link to that will, of course, be down in the description. Okay, and that is all for today's video, folks. Did you enjoy this report roundup? Let us know in the comments below. We love to hear your feedback. And while you're down there, don't forget to smash those like and subscribe buttons and turn on those notifications so you don't miss our next one. If you know someone who would love content like this, consider taking a second to share this video with them. Thank you all so much for watching, and we will see you in the next one. Until then, this is Guy, signing off.